Hello, I'm Russ, and welcome again to another edition of the Dapper Dividends Dividend Portfolio Update for the month of August. Why? Because, my friend, I like you more than a Jim's Original Maxwell Street Polish with extra grilled onions. And before we get going, remember, this is not financial advice. I am a welder that barely graduated high school, but I have a passion for investing, for passive income, and the proof is in the pudding because, well, I'm telling you, I have a net worth of almost $1 million, and I must be doing something right because I've gotten this far. We're on the precipice. That's our first stop. So always consult a professional before buying or selling anything in the stock market. Oh boy, because it's for fun and entertainment. So the selling of Realty Income, ticker O, and buying of Agree Realty, ticker ADC, and VICI Properties, ticker VICI, has continued. Basically, in my opinion, Realty Income is a $50 billion plus company that is really big and is finding it really hard to find growth that is going to move the needle. And they've been expanding beyond their triple net lease retail, right? Those are when the tenants pay for maintenance, property taxes, insurance, all those things, and Realty Income just collects the rent. They've been buying and expanding into casinos, data centers, Europe. They've been getting into private capital. That is coming, and they're really just trying to find ways to generate alpha to grow Realty Income even bigger, and it's kind of been lagging. Companies like, again, Agree Realty and VICI Properties. So look, over the last 1 year, Realty Income has a total return of 0.6%, Agree Realty about 1.6%, and VICI about 5.6%. If we bump that up to 3 years, still Realty Income underperforms both Agree Realty and VICI. 5-year total return performance, same story. Realty Income about 22.7%, Agree Realty 37.9%, and freaking VICI almost a 90% total return for a REIT. And if we go out 10 years, it's not comparative exactly because VICI really didn't start publicly trading until almost 2018. But still, Realty Income over those 10 years has a total return of 115.8%, with Agree Realty 291%. And there you see VICI, since it started publicly trading, a total return of 181%. And even if we max that out, check it out, Agree Realty still barely outperforming Realty Income on that total return basis. They both started publicly trading in 1994, and this only goes back to 95. It's very close. They're basically about even. And I think because Realty Income is just so big and finding it so hard to move the needle, their dividend, look, is very safe. Nothing to worry about the dividend. But if you're expecting capital appreciation, stock price growth, I just don't think we're going to see it compared to an Agree Realty or a VICI Properties, because Agree Realty is much smaller. As Joey Agree says, they are laser focused on retail and retail only. Those fungible rectangles, right? When a company moves out, they can easily move another company into those squares, those fungible rectangles. And this is what really kicked my butt into buying more Agree Realty. I had about 100 shares with an average cost of $59, and I hate losing that average cost below 60, but I saw Joey Agree very recently drop about $500,000 on 6,950 shares with an average share price of $72.13, which tells me he knows his company better than you do and better than I do, and he's confidently putting his own money, right? Not restricted shares, nothing, gifts, grants, any of that. No stock options from the company. No, this is with his own personal money, and he has never sold any shares of Agree Realty as far as I can tell. So it's just a very good sign. And what this kind of tells me, right? I think that Agree Realty has become more valuable, and it is going to keep increasing its profitability, which means by me waiting for that $60 share price where I wanted to buy more, I don't think it's going to happen. And if it does, fantastic. I'll buy more there because I plan on holding Agree Realty 10 plus years. It's going to be a very long-term hold for me. It's in my retirement account. It's in a tax-advantaged, self-directed IRA, so I am not paying any income taxes until I pull those shares out, right? When I'm 59 and a half or older. But I study a lot of Warren Buffett, and he mentioned explicitly with Walmart, liked Walmart, thought it was a great company. He bought it and wanted to keep accumulating at that price or lower, but it started going up and up and up, and he did not keep buying more, which he says cost Berkshire billions of dollars. That was his mistake, and that's a lesson I've learned. So he ended up selling because he didn't buy or put any more in, and then he had this little small position and the price just kept going up and he got rid of it. And especially as I'm recording this, there is now almost near certainty that there's going to be multiple rate cuts in this year and more in 2026, which, hey, that's only going to add fuel to the fire of people, investors coming back into REITs because they're yield hungry and they want higher yields, right? So if the short-term interest rates, right, what the Fed sets, what the banks loan to each other overnight, if that starts falling, then people are going to want higher yields. Where do they get those? Traditionally, REITs, real estate is pretty stable. So companies I expect like Agree Realty, Realty Income, VICI Properties are going to see even more of a tailwind. But remember, bond investors set the long-term interest rates, which is mortgages, things like that really affect property values. So that's really what REITs care about. A lot of investors compare a REIT's yield to the 10-year treasuries. But what we should remember is that higher rates hurt REITs and suck investors away toward the safety of bonds, but lower rates help REITs on a few fronts, but most importantly, it brings people back into REITs looking for those higher yields. So with that being said, my Maxwell Street Polish with extra grilled onions eating friends, I bought more VICI Properties, 150 shares in the month of August. Average price $32.50, gave us $270 of patty or projected annual dividend income. 66 shares of Agree Realty, ticker ADC at $72.26. That gave us $202.62 of patty. If you haven't read The Income Factory yet by Stephen Bavaria, I highly recommend it. Very educational, and it got me thinking about having a couple investments that I'm more concerned with that income, right? Because if you get an 8% yield, 2% growth in the stock price, that's 10%. That's what I'm doing with Ares Capital, ticker ARCC, where I bought 60 more shares. Average price of $22.33 gave me $115.20 of patty. Kind of got a foolish position with Zoetis, ticker ZTS, bought 11 more shares. Average $148.28 gave us $22 of patty. They're having some issues with Librela, which is arthritis medication for your dogs, and they have also it for cats. Some users have said that it's had some nasty side effects. Zoetis is saying that it really isn't as bad or widespread as people are thinking. So Librela is about 6% of revenue for Zoetis. So even if it went away, it would suck, but it's not going to crush the company. I want some more international exposure, so 20 more shares of SCHY. This is the Schwab International Dividend ETF. It's kind of like SCHD's international version. So those 20 shares had an average price of $27.40. Gave us $21 of patty. Then 2 more shares of the Vanguard Total Stock Market ETF. This is about almost 4,000 companies. You're getting the whole US stock market. Well, almost. There's some really nano cap stocks, very volatile penny stocks, that micro penny stocks that aren't in there. So it's almost the entire US stock market. But again, almost 4,000 companies. And I bought 2 shares of that, $314.45. Extra patty of $7.42. 5 more shares of SCHD, the Schwab US Dividend ETF. Those 5 shares had an average price of $27.55, which gave us $5.10 of patty. Right now, I think a lot of people have soured on SCHD, but it's performing like it's supposed to. It's not going to be a market beater. It's to be bought for growing dividend income and stable growing dividend income from quality dividend paying companies. And I think a lot of people jumped into this thinking they were getting a high yield and they were going to get a lot of share price appreciation. But in my opinion, it's doing what it has always been designed to do. So it's kind of a funny thing. It's like SCHD is like, hey, I didn't change. You all changed. And whether that's good or bad, that's for you to decide, but I am holding and slowly adding more shares of SCHD. 1 more share of Harrow Incorporated, ticker HROW. I think I'm at 298. Eventually I'll get to 200. That's my goal. They do not pay a dividend. Maybe someday they will, but I think they are a company that has a lot of room to grow. They're an ophthalmic company. They do things with the eyes like numbing the eye for cataract surgery and also treating dry eye disease. So I like them and I want to hold them for many, many years to come. So overall, that gave us a total patty gain of $643.34 in the month of August. We only sold one stock and it was a big one, 130 shares of Realty Income, so we've really been ramping down that position. Average share price $57.98, and that was a projected annual dividend income loss of $419.90. But when we subtract that from the gain, we get a positive August net patty of $141.21. And now the time is here for dividends received, which monthly dividend stocks. So this is not going to be as big anymore. From Realty Income, ticker O, $61.87. AbbVie, ticker ABBV, paid us $41. MLPX, the Global X MLP and Energy Infrastructure ETF, $40.15. Remember, MLPX is a big basket of midstream companies in the energy field. So you have upstream, downstream, and midstream. We like the midstreams. They're not really affected by the price of a barrel of oil because they have contracts with the companies that move the oil through their system of pipelines and their network. So we like them. And this is a tax efficient way to not get a Schedule K1. So we like MLPX as an ETF. And the last two are more monthly paying stocks. Main Street Capital, ticker MAIN, hit us with $38.25. And Agree Realty, which this is going to go up from here. Ticker ADC, $26.11. All in all, in the month of August, we received $207.38 of dividend income. And speaking of MLPX, it was our only dividend or distribution increase, which increased $2.20, good for a 1.4% increase. What's that you say? You wanted to hear about my overall investment portfolio? Well, thank you for asking. Check it out. Some of you in the comments have said, Russ, we get it that your wife doesn't want to show the exact dollar amounts of all these positions, but you can show us percentage. So voila, you asked, here it is. We have the total percentages, and the biggest one is in our 401k. Well, my 401k is DFUSX, which is the S&P 500. It's Dimensional Funds' version. Hey, why didn't you go VOO? Well, it wasn't offered. I would have picked it if it was offered, but this has a 0.08% expense ratio. VOO is 0.03, so it's a little bit higher. Look, I'm doing the best with what I have to work with, okay? With mutual funds, you are severely limited with what you can pick, which is why some people only like to contribute up to the employer match and then they do the rest of it like you can do with a self-directed IRA. You can pause the video, zoom in if you want to see these a little bit bigger. 43% almost of our investment portfolio, again, this is just anything for my wife and myself. This is not any savings accounts, emergency funds, travel funds, 529 accounts, anything with her and my name on it. And then on down the line, we've got more ETFs, VVIAX, Value Index Fund, 21%, and then a mid-cap fund from Fidelity, FSMDX, 7%. Again, those are all in my 401k, as you can see. Then the number one individual stock position, Zoetis, ticker ZTS, making up almost 3%. We'll drop down all the way to number 22 is Realty Income. That one is probably going to be gone by the end of September, but it's currently down to about 0.5%. And then in the last, cash. I'll just tell you, we have about $2,233 as of this recording sitting in cash. So we'll deploy that. When we deploy it, the patty's going to go up like magic. We're going to get more money from Realty Income. So it's a little bit of a fluctuating situation right now where Realty Income's going down. We'll get cash and put that into some other things. And then on the dividend income side of things, DFUSX, $1,851. Again, in the 401k, that's our biggest. But Ares Capital in the number 3 slot, $950. I will get that to 1,000. That's a goal, just to say I'm getting $1,000 a year from Ares Capital. Magic number 666 from VICI Properties. And then all the way down to the number 21 position is $58 from my wife's Roth. And I didn't update this from today. We contribute about $200 every week to her Roth. It only buys VTI and it has done incredibly well, up over 30% 50% since we started doing this. In December of 2023, it was only $50 then. Recently, we've decided we should probably put more and build that up quicker. So all in all, about $8,883 of dividend income across all our portfolios. And again, once we deploy all that cash, that's easily going to be over $9,000. And then we constantly have new money going in every single week. So that is just going to keep going up from there. And if you do want to see what this welder is buying and investing on, click the link below. Follow me on Blossom if you would like to, or sign up for the free and fantabulous weekly newsletter where I share all these stock portfolio moves and some stocks about to go ex-dividend and some interesting investing thoughts that I'm having with you every week for free. And speaking of Realty Income and kind of the last straw that made me want to sell, I shared that red flag that I think you should know about as an investor going forward. So if you want to find out what that is, click on this floating little box next to my head and I'll tell you all about it there.